Hello and welcome to Fintech Impact. I'm your host, Jason Pereira. Before we get started, I'm going to remind you yet again to sign up for my newsletter at jasonpereira.ca. And why do I do this? Because I know what the listenership numbers look like, and I know what my subscriber numbers look like, and there's a big difference. So that said, please do so when you get the opportunity. So on today's show. Today on the show, I have Hayden James, co-founder and CEO of Fraction. Fraction is a company that is enabling a new method for getting equity out of your home or providing equity in order to purchase said home. And with that, here's my interview with Hayden. Hello, Hayden.
Hello, how are you, Jason?
Good. Thanks for taking the time to chat.
Absolutely.
So Hayden James, co-founder and CEO of Fraction. Tell us about Fraction.
Yeah, absolutely. So Fraction is a digital lending platform based in Vancouver. We have the broad vision of transforming home ownership and how people finance, buy, and sell homes with a focus right now on providing liquidity for home equity.
Okay. So we'll talk about what that business speak means in a minute.
Yeah.
But tell me about the origin of Fraction. What was the impetus for the creation of it?
Yeah, absolutely. So my co-founder and I, so my co-founder's name is Josh Baker. We're working on a previous project called Amplify. And it was essentially a fully automated social media marketing solution for real estate agents. We're working out of a real estate office here in Vancouver, and we got to see a lot of the reasons why people were selling their homes. And this is 2018. And then on the other side,
the reason people were selling homes in Vancouver, there's been a lot of articles about that. Okay, so anyone who wants to know about how you lend their money from the fentanyl trade might want to look at that.
Absolutely. And then on the other side of that, there's definitely a lot of people that were looking to invest in real estate, but didn't actually want to manage the asset itself. And so we essentially had this liquidity problem. And so we looked at how we potentially bridge these two pieces. One of the early questions we started asking ourselves was, could someone sell shares in their home? And basically the conclusion we came to pretty quickly was it wasn't really a fair trade-off for either side. So the homeowner didn't want to give up control and the investor didn't want to be at the whim of the homeowner. So what we ended up coming up with was essentially a debt-based product in which the rate of loan is based on the appreciation of the home. And so essentially it looks a lot like equity, but it provides the homeowner with control and it provides the investor with downside protection.
Good. So it's interesting. So when you approached me about coming on the show, I jumped at it because let's, first of all, before we get there and I get the punchline to this story, tell me about how you facilitate the transaction in home ownership for the owner. What is it you're doing that is different from us, the universe? Because we kind of poked around it. Let's get to the crux of what your technology is.
Yeah, so absolutely. So the key piece of us is that it's a debt product that enables homeowners to take a portion of their home equity and put it into alternate investments through a vehicle that hasn't been really available before. And one of the keys is that there's no debt servicing or payments. And this enables a lot of different things for homeowners and allows us to build a lot of different products on top of it because creating liquidity for home equity is a transformative change compared to what it is today.
So again, and we're beating around the bush again. We're talking about here is that we're talking about the ability for you as a homeowner to monetize on the sale of part of your home, not the entirety of it, right?
Yeah.
And this is, the underlying technology behind this is, care to share it? Is it blockchain?
Yes.
Yes, there we go. Thank you. And I'm getting at that. So, and the reason I get that, not just to toot the blockchain horn, it's because one of the most common use cases I've ever spoken about on this show for blockchain is the ability to fractionalize ownership of any asset. And the most illiquid asset in the average person's lives is their home. And I said, we talked about this before, if I as a homeowner wanted to access cash, there's certain ways I can do it. Of course, I can borrow, and the biggest asset I can borrow it against, and the lowest cost of borrowing would be to borrow against the home because it's a secured loan. However, of course, that comes with a carrying cost, right? Whereas if my house is already paid off and I want access to cash, but I don't necessarily want to take out debt, I could theoretically sell a stake in my home that would basically then go to another buyer. And I would always be able to buy that back or buy back something similar at a market rate. So that's interesting. So let's talk about there's an entire value chain to go down here. So there's someone basically discovers your site, discovers that they can monetize through your site. What is the process for them fractionalizing their home?
Yeah, absolutely. So they can come to our website, submit some basic questions. So we ask them things like, I have a mortgage, do you have remaining on your home? What do you think the asset value is? There tends to be a difference between what it actually is and what people think their home is worth.
You're kidding. The endowment effect that happens in real estate, that is shocking to me.
Yeah. So we kind of want to understand where your thought process is. And then from there, we're able to qualify you pretty easily. So because we don't have to worry about things like a carrying cost, your credit history or your credit score is not that important to us. And then from there, that comes in our system. We then partner with a mortgage broker who walks you through the process. After that, we get an appraisal and inspection done, give you an initial offer based on that appraisal. And then from there, if you decide to accept that offer, we essentially just provide the mortgage documents through our platform. And it's a very, very simple process.
All right. So you assess it. Now, of course, one of the questions that always comes up with this when I've kind of blue skied this idea in the past is what happens if the owner now basically they don't own the entire thing? So are they disincentivized from maintaining it? Or let's say they get to a stage in their life where they basically don't maintain it as well. Is there not risk there for the investor?
So this is like a key piece of our product. So because our product is technically a debt instrument, not actually equity, the homeowner still owns the entirety of the home and a majority of the home. So in the case where let's say the homeowner deteriorates the home, the investor can still recoup their principal plus a small rate.
So essentially, again, we're going back to this. You're a debt instrument, but sort of, because the variable payment is based on the market change in the value of the property.
Correct. Yes.
Exactly. So technically you're not selling, and I get that because the complications of selling fractional ownership is an issue, but essentially what you are is you're a variable claim against that. And I guess that's interesting too from a Canadian tax standpoint and a US tax standpoint because of the exemptions on principal residence capital gains.
Yes, exactly. And so it's also because the way we structure it, there's technically interest payments that don't come from the homeowner, but an interest reserve. We're able to claim those as well. And so it's actually very tax efficient.
So where's that interest reserve coming from? Where's the money from that coming from?
Yeah, so I can walk you through that. So let's say you're a homeowner and you want to you have $1 million home that you've paid off. And you want to take 10% of that, so $100,000, and put that into a retirement income portfolio that pays you a dividend. We'd give you that capital or that essential loan at, let's say, $100,000 at a 3.5% rate, but on a 5-year term. But what we'd actually end up doing is putting $118,000 on title, which is the interest over the 5 years, and reducing that interest rate. So the effective cost of borrowing is the same, but we make payments on behalf of the homeowner, interest-only payment, to our funding partners.
So basically that difference, and if that person sells the house early, let's say a year later down the road, I decide to go out and you have this interest reserve still built up on my home, what happens then?
Yeah, so based on the time period that you sell your home, the amount that you owe would be that time period plus the interest that's been paid or the appreciation. And
so why this versus a pure equity play? Because I understand a couple of complications, but let's just have that conversation openly.
Yeah, absolutely. So the problem with the pure equity play, and these products have actually played out, is that you have to compete for capital in the market. And so what ends up happening is because that investor doesn't have control, they want outsized appreciation, meaning that if they put in, let's say, 10% of the home's value, they want to take out 25 or 30% of the appreciation. And those are some of the products that exist today. And so in order to get that down to, let's call it like a pro rata rate, there needs to be some sort of downside protection for the investor.
Okay. So simple enough.
Yeah.
But again, and I mentioned it earlier, from a tax standpoint, it's interesting because in Canada, principal residence is exempt from taxation. However, a separate investor would not be able to claim that on their portion, right? And then in the US, it's the first $250,000 per spouse. And again, that if they have a pro rata amount owned by a third party, that amount is not applicable to that third party. So you're still able to take advantages of the tax play within the tax code by not making this an equity play.
Yes, exactly. Yeah. And then on the other side of that, they can put it into investments that provide them income as well. And so they can actually increase their income, use the interest payments as a subsidy on that, and make it even more tax efficient.
Good. So impressive. So where are you finding the investors for this?
Yeah. So we originally were funding deals out of our private network or private capital. And then pre-COVID, we were putting together partnerships with some of the largest financial institutions in Canada. And then with the current environment and their focus, we've transitioned to US private capital sources that we're funding these basically off our balance.
And the appeal to them is what? The tax efficiency, the exposure to the market,
There's a combination of things. So when you look at our loan to value, which is a maximum of 40%, plus the guaranteed payments, we're actually a very conservative product, even compared to traditional mortgages, but we have a slightly higher rate of return. And so for the investor, they get the upside of the appreciation with the downside protection of debt. And for the homeowner, they get the lowest rate possible without payments. And so it's kind of a win-win from both sides.
Interesting. So what determines the amount of reserve you would have? So if I'm going to go for the maximum 400,000, 40%, I'm just using $1 million proxy here, 40%, what determines the amount that is coming to me versus that reserve?
Yeah, absolutely. So it's just based on the minimum interest rate that we charge over the 5-year term. And so that 100,000, if we're doing, let's say, a 3% minimum rate or 3.5% minimum rate, that would be 18,000. That just correlates to the amount that you're borrowing.
Okay.
And so it's,
So at the end of the 5-year term, though, what happens at that point? Is it being recapitalized? Like what happened? Like
So there's 3 scenarios for the homeowner. So one is that the homeowner sells during the term, like we kind of discussed, and they pay us out the greater of the minimum interest rate or the appreciation on the property. The second is that they renew. So we essentially take that original amount, add another 5 years worth of payments on and renew it for another 5 years. And then the third is that, let's say they take in that $400,000, like you said, put it into the market in some sort of diversified fund. And that's outperformed the housing market, and they use that as a hedge, and they just buy us out. And so that's kind of the 3 different scenarios.
And that's an interesting piece specifically around what is going on in the marketplace today, or what the right this moment, but in general, the growth of reverse mortgages, right? Because reverse mortgages are a methodology for extracting up to 50% of the equity out of a home, at least in Canada. I'm not sure what the limits are in the US, and putting that into the market as a means of funding consumption going forward, which is technically to a lot of us kind of the last resort, right? If they're insistent on keeping the home, it is the last resort option is to basically do a reverse mortgage. And I say it's the last resort because interest rates tend to be higher than conventional mortgages. And on top of that, especially if it's done, we'll call it younger, which I would say younger these days is 70s. That person could live to be 100 and they could pass away with no equity left in their home. And you know what? Yeah, here's the problem. They might be able to live in that home the entire time, but maybe they shouldn't be living in that home anymore after a certain point. And I've had that happen where someone had to transition to a retirement home, but because they reverse mortgage so early, there was no equity left. So something like what you're talking about here is more advantageous, because essentially it looks like the rates are probably lower than what you're seeing on reverse mortgages. Is that about right?
Yeah, so we're much closer to, like, let's say a HELOC rate or a second mortgage right now.
Exactly. And there's a bunch of optionality built into this. So it's an alternative, but it's also one that essentially, later on, if the value of the home does increase and they capitalize on that, they could potentially see themselves staying at a ever moving 40%, right? So it's an interesting play.
Yeah. And actually on the other side of that, they can actually be in an advantageous spot where the investments that they invest in outperform their home. And so they're actually in a positive net worth gain. Yeah. On the other side.
Excellent. So this begs the question of where are you sourcing the real estate properties to basically to securitize?
Yeah. So there's essentially 3 different channels we use. One is directly through our website, so you can go there and apply. The second is through mortgage broker relationships. And the third is through investment advisors. And so people that are coming to investment advisors looking to invest in these properties, and they think it'd be a good idea to take, let's say, up to 40% of their property's value and put that into wealth management options.
Good stuff. So out of curiosity, thus far, first, okay, so are you free to talk about how much volume you've done thus far, or is that still a trade secret?
Yeah, I can't disclose that.
No, sure. No.
I can say, we're in the tens of millions of dollars in applications. I can say that. Good.
And in general, what's been the response from the owners of these properties? First of all, how long does it take to get them to wrap their head around this concept? This is not something new. This is definitely something new to them, right? So
yeah, absolutely. And for any new financial product, education is key. And so we've worked really hard to make it as simple as possible, where essentially it's a loan that's based on the appreciation of your home. And so just trying to make it as simple as possible. But it does take some education, and we rely on our partners for that. So mortgage brokers, financial advisors, making sure they're getting the right product. We're not the best product for everybody, and we're not scared to say that, but we are a really great product for a lot of people. So the reception's been really great. There's a lot of, especially if you look at now, being able to tap into your home equity instead of having to pull out your retirement funds or your RSPs is a really big upside. And we have a lot of people right now too that are looking at the stock market and seeing the future and going, maybe a good time to buy is in the next, 3 to 6 months. And so
that is not an endorsement to go speculate, people. Okay. That's just a big disclaimer there. All right.
Yeah. Cut that out.
So we're going to leave that in. It's fine. We're not cutting that out because I'm going to cover my butt one way or another. Good. So, all right. Interesting. So, you took a revolutionary technology and you gave it a very practical application. And I think, like I said, this is one of the more promising aspects. And I think one of the interesting things about this show, and people have been following my podcast since the beginning, is blockchain went from this abstract thing that people didn't understand, and then to this that was just about currency speculation to some degree and nefarious means, to, oh my God, this technology could revolutionize a lot of things we do. And what's really nice is in the last little while, I've been having a lot of conversations about people who are finally starting to execute on the promise of what blockchain is doing. So it's nice to see that this revolutionary technology that, once the crypto winter hit, a lot of people just said, oh, well, there's that. It's like, no, this is going to be a core backbone of so many things we use going forward. Talk to me about why blockchain is the right tool for something like this? I've got my reasons for believing it, but let's have an open conversation about it.
Yeah, absolutely. So it's interesting, obviously, like we were talking about, because on the retail side, there's an option for liquidity if you can get the right distribution, as well as taking out a lot of the intermediary fees that are included in securitization. And so we're doing kind of a dual process right now, going through traditional channels with institutional investors because they have a much more difficult time adopting this type of technology when it comes to regulation. But on the retail side, there's some really interesting things that we can do. So some interesting products are things like home ownership diversification. So 70 to 80% of your net worth is in your home. That's the only home you own. We can help you take 40% of that and put that into a diversified portfolio of properties that can be traded. So that's like a really interesting thing that this enables. There's obviously some downsides. The technology is new. From a regulation standpoint, from a regulatory standpoint, there's a lot of issues that came out of that original kind of crypto bubble and a lot of mistrust that was well founded. So having a useful application that has underlying collateral that is secure is a really good use case for blockchain, because you can actually go back and audit that if you need to.
So here's another question for you. Is anyone using this type of structure as an alternative, just a conventional mortgage to just own their home thus far?
In terms of like buying a home using?
Yeah, because I mean, I just used your calculator online to see what it would look like with me. And you showed me equity today and equity with fraction. I looked at this and said to myself, could this replace a first mortgage? I mean, the rates are you're not quite there yet, but is anyone actually using that in that instance?
Yeah, so a product we've been working on, we haven't launched yet, essentially is a product that combines the product that we've been talking about, this home equity product, with a conventional mortgage. So by enabling institutional investment into a residential property, we can actually lower the cost of a property and increase home affordability. So that's something that we're going to be launching. We haven't launched yet, but have already put the work into doing.
So that's an interesting market expansion there, right? Because essentially you become an alternative to a conventional mortgage, and that's an alternative that does not require monthly outlays, right? Now that said, if you ever want to own the home outright, you're still going to have to save the same amount of money, right? But I mean, if I wanted to just basically for a couple of years, not have to worry about that and worry about maybe renovations or invest in anything else, real estate, you name it, that frees up a huge line item on people's income statements to basically do that.
Yeah, absolutely. So you can imagine where you're putting 70% of that mortgage payment towards a home and 30% towards alternative investments that are more diversified. And so instead of all your paycheck going towards your mortgage and the rest going to expenses, you actually have a nice portfolio at the end of the day.
No, that's interesting. I mean, especially if you're capitalizing against the increase in value. I mean, I can almost foresee a world where people are like, you know what, I need to maybe buy the bigger house for the next 10 years because my kids are young. I need the space. I need whatever it is. I do plan on downsizing. However, I really don't want to basically take on the mortgage that's going to be that much bigger. In theory, they could utilize your platform, basically ratchet up their home size with the intention of ratcheting down later on, and basically not be out of pocket for the differential in cash flow if they chose to be. And the trade-off would be they give up some of the upside. Right. So that is, I mean, when we're talking about timelines that are short, I'm never going to talk about real estate not going down. We're talking about decade, like maybe over 2 renewals. You're pretty safe historically. So that's an interesting tool you have there, my friend.
Yeah, absolutely. And the people that come to mind are the, people that are having kids are looking to buy an extra bedroom, living in a 1-bedroom apartment that need to upsize, so that have real needs, not just that want to have a nicer kitchen. So there's like a real use case that can be extremely beneficial.
Yeah. Now you got my, you get the wheel spinning right now.
Yeah.
Interesting. Yeah. No, I'll be very curious to see how all this goes going forward. So overall, things are going well. Receptions, you're filling both sides of the marketplace. You're acquiring the capital you need. You're providing a useful utility and function there. Any kind of negative blowback or any kind of people saying like, wait a minute, you want me to give up whatever? Like, I'm not going to do that. So what's the negative feedback thus far, and how have you combated that?
Yeah, absolutely. So, you were talking about something earlier called reverse mortgages that have a negative connotation. And we serve some of the same purpose in providing a product that doesn't have payments to people that are looking to increase their disposable cash flow. And so we get associated with that quite often. The difference is how we implement it. And so sometimes it takes some education and explanation. The other side is people who are extremely bullish on real estate, who why would
I give up the 15% I'm making per year?
Yeah, exactly.
Actual conversation I've had. Okay.
Yeah.
Actual conversation, sadly.
Oh, multiple times. And, it's when you look at that in a vacuum, like Vancouver from 2013 to let's say 2018, sure. But over a historical context, that just doesn't happen.
I can show you the historical charts that show you it's inflation, right? And
Yeah,
if you want to
exactly.
argue it didn't happen here, like, oh, things are different now. It's like, no, things are different. Money got really cheap really fast.
Yeah,
Right?
exactly.
Not anymore.
No. And so
It's
one of the things
cheap,
when still very cheap and getting
still
cheaper,
very
apparently.
cheap, but yeah, getting cheaper. But there's a difference between double digit interest rates on mortgages. People paying 20% going down to people paying 3 to 4, right?
Yeah.
That is an incredibly bullish run on any kind of leveraged asset, right? I'm sorry, you can't go from 3. You can go from 3 to 4 down to 0. That's as far as it can go.
Yeah, exactly.
Bank's not going to pay you to have a mortgage.
No, unless you're in some places in Europe right now. But
nah, that's a misnomer.
Yeah, exactly. But yeah, absolutely. And so, yeah, to be like, there is some negative blowback when it comes to people that are really bullish on real estate. And so that's their own theory. But we looked at the math, and one of the reasons and one of the real things that we wanted to tackle was we wanted to put the consumer in the best place possible at any time. And so by being able to charge the minimum rate possible when the market's down and charge a little bit more when the market goes up, they're in the best position they can be.
Well, in terms of their thoughts, as Nicholas Nassim Taleb says, time is the only arbiter, and it's a matter of time before they are proven incorrect. Or I am, but I highly doubt that. Anyway, that said, excellent. So before we wrap up, there's 3 questions I ask everybody, and I warned you that I typically blindside people with them because they clearly have not listened to enough of my podcast to be ready for this. The first one is, if you had one wish for something you can change in your company or the industry as a whole, what would it be?
That's a good question. I wish that founders would look at raising equity capital for what it is, which is giving up a large portion of your company instead of as a sign of success.
Yep. Fair enough. I mean, it's, in fairness, there's a lot of risk to startups. And yeah, I get why that happens. But at the same time, I've seen some founders being left with single digit ones, and you're just wondering like, wow, that's a lot to give up on the way up, man. So, I mean, I really hope that money made it worth a heck of a lot more than it would have been otherwise.
Yeah, I think sometimes founders judge success based on the amount of money raised rather than the impact or the trajectory of their business.
Excellent. Second question for you is, what's been the biggest challenge in getting to where you are today?
Originally not coming from finance. So building that network out, especially on the institutional capital side, it's very much who you know. And so putting that network in place has been challenging and time consuming, but worth it.
Good. Well, I mean, it's interesting. There's a common thread amongst so many of the people in these fintech startups is, none of us came from finance. Like, that's good and bad. Right? It's good because the preconceived notions of the way things are not a roadblock in your head and an obstacle. However, some of the fundamental things where it's just like, oh, you mean people wouldn't go for that? Like, no, that's not how things actually work. Unfortunately, there is definitely a graveyard of non-financial background fintech startups that just got decimated for lack of understanding of fundamentals of the actual marketplace. Glad to see you're not one of them. Let's see. And the last question I ask is, what excites you the most about what it is you're working on and keeps you getting up out of bed to fight the good fight every morning?
Yeah, absolutely. So the biggest thing for me is I look at my friends and family who either would like to get into the housing market or who owned homes and had to sell them because they couldn't access their home equity. And that was just based on the fundamentals of how real estate worked in the past. And so what excites me is that we can change that and make real estate more inclusive and more affordable for everybody, which is a major driver of wealth generation.
Yeah, I have mixed feelings about what you just said there because, I almost look at what you're doing as potentially inflationary as well, which is which then hurts affordability, right? Anytime, unfortunately, there's duality of that. Anything you do to make real estate more affordable for the masses, all it does is create a market distortion that basically pushes prices even higher, and therefore a feedback mechanism that results in it being less affordable. Right?
Yeah, I think the key, I can tackle that actually. So I think with the home buyer product that we're talking about, which combines our product and the mortgage, there is a slight penalty to that. Mm-hmm. And so it is much more of an equalizer rather than a leveraging tool, because like we were saying, you do have to participate in the upside as well. Yeah. And so for someone that can afford to go take out a conventional mortgage for that same home, there might be in a better spot to go do that, which is a key when we design that product.
Yeah, I mean, again, it's a part of it is a cash flow issue. I mean, I kind of look at, I'm sure anyone who did what you're doing now, and we're recording this, of course, in the age of COVID, who basically used your product and does not have that monthly cash flow going out is probably thanking their lucky stars right now that they basically do not have to go to a bank and ask for a deferral on a mortgage. And it may, that only lasts 6 months. Maybe they're in a position where their job is insecure that they're not going to get it back after 6 months. This actually is, quite honestly, this type of structure is one that is probably likely to lead to fewer bankruptcies than conventional mortgages. That's for sure.
Yeah, and a lot less people having to do fire sales on homes. And so they're able to ride out this kind of downside in the market, why credit gets restored. And so it can actually be a positive change.
Fantastic. Well, first of all, again, very encouraged to see blockchain's promise becoming blockchain's reality. I think it makes a lot of sense what you're doing. This is one of the use cases that I've been talking about for years. Nice to see someone actually doing it. I remember I very early on mentioned it to a friend of mine. He's like, "Oh my God, it's brilliant. We got to do this. We got to jump in and do it." I'm like, "I guarantee you someone else is like, no, you just came up with this on the spot." I'm like, "Sure I did, but just Google it." And sure enough, I was like, here's 12 different plays right now. I was like, let's see what actually comes out of it. So yeah, very pleased to see it. I'm very interested to see how this pans out in the future. And I think if you can get the cost of borrowing down to conventional rates, the world is your oyster, my friend. I mean, honestly, just thinking about, as I said, even the simple use case of, you know what, need a bigger house for the next 10 years, want to move to a condo when that's all done. I think that is an incredibly appealing sales pitch as to not swallow up more of my monthly cash flow and I'll give up some of the upside. I'm good with that. I'm sure, again, the people who believe in the 15% upside disagree with me, but again, we'll see what happens there.
I'll let them stay in that camp.
So Hayden, thank you yet again for taking the time. It's very much appreciated. This is very interesting, and I hope everybody takes the time to check out what it is you're doing and follow up with your progress going forward.
Yeah, absolutely. Really appreciate your time, Jason. Thank you.
Excellent. Thanks. So that was my interview with Hayden James of Fraction. I hope you found it interesting, and I hope you found it as compelling and market expanding as I did, because I think that if this works, there are some big implications for how this could roll out to the rest of the world. So as always, if you enjoy this podcast, please leave a review on iTunes, Stitcher, wherever you get your podcast. I really do appreciate it, and it really does help people discover the podcast. So I often have people come up to me saying they love my content and how can they help? And I was like, my first response is, have you left a review? If the answer is no, pull out your phone and do so, please. Thank you very much. Until next time, take care.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on iTunes, Stitcher, and Google Play, or find more episodes at jasonpereira.ca.